You are watching 2+U Nevada. Thanks for being here this afternoon. Joining us, Tom MacDonald from Mutual of Omaha Mortgage. And Tom, you're here to talk about reverse mortgages in our current market and strategies surrounding those. But
Correct.
First of all, tell everyone at home your background.
Well, I first started in reverse mortgages with Wells Fargo. At one point, they left the business, and so I bounced around a little bit. But now I'm back here in Reno with Mutual of Omaha.
Wonderful. And you've been doing this for decades.
Yes, since 2002, so over 20 years.
Fantastic. Give us a kind of a brief primer on what reverse mortgages are.
Sure. The first thing to know is it's just a mortgage. So often people think the bank gets the house and they're giving up everything, but it's just a mortgage without monthly mortgage payments. Everything else about it is about the same in that you have a lien against the house, but you're not making the payments. There are other things going on that make it advantageous compared to a regular mortgage.
So let's talk about, is that what you call a proprietary reverse mortgage?
Either reverse mortgage. There's two types of reverse mortgages. There's the FHA insured version. That's a home equity conversion mortgage, letters HECM, we pronounce it HECM. And then there's proprietary. The FHA version is done probably 95% of the time. And it has the most flexibility. But sometimes it doesn't fit a client, and so the proprietary may come into play in that particular case so that it can be done rather than not done at all.
And you can get a fixed rate with a HECM?
You can. For both of them, both the HECM and the proprietary, you can get a fixed rate. But right now the adjustable is the most flexible, and you get more money because like a regular mortgage, fixed rates usually have a higher interest rate compared to adjustable rates. And right now we're thinking, of course we've been thinking this for a couple of years, but we think that interest rates are going to be coming down. So having an adjustable rate with rates coming down makes more sense than locking in today's higher rate.
And you're saying with adjustable rates, you can take funds three ways. So lump sum,
right,
with 60% in the first year?
There is a limit in the first year. Back in the 2008 timeframe, people were taking all the money, and then when the market crashed, FHA had to make it up because there's a mortgage insurance premium that people paid. It's an insured, FHA insured. The lender does the loan, it's their loan, but the FHA insures it. So FHA lost a lot of money in that 2008 crash, and so the Congress changed the rules and said, okay, you can only take so much to begin with.
And with that, the borrower actually receives money?
It kind of depends on how everything's structured. If someone has no mortgage at all, there's a lot of money coming to them in one way or another, either the lump sum, monthly disbursements coming to them, or a line of credit. Any money that isn't either dispersed up front or coming to them on a regular basis goes into the line of credit. And that line of credit is unusual in that it grows. It grows at the same interest rate we charge borrowers on the money they're actually using. Many times people use it to pay off an existing mortgage, but we're going to be talking about some strategies later on people who don't really need a reverse mortgage now, but how it might benefit them later in life.
Oh, wow. Okay. And so we just talked about adjustable rates a little bit. Let's talk about proprietary reverse mortgages and the advantages that come with those.
So typically we used a proprietary, we called them jumbo loans before, because you needed about a $2 million home to make it work. Things have changed a lot. And so now maybe a $600,000-$700,000 home might qualify for proprietary. For starters, FHA has a lot of rules about condos. So proprietaries have looser rules. There's still some rules, but a little looser. FHA has a home value limit they use to calculate how much money you get. That's roughly $1.2 million and change right now. Before it had been as low as $240 when I first started. But the proprietary loan doesn't have a limit at all. So somebody could have a $8 million home and get the calculation based on the full $8 million rather than the limited $1.2 million that the FHA would do.
Wow.
So a couple different things going on there. When we have a client, we look at both. So generally FHA fits, like I say, 95% of the people, but we also run the proprietary side by side so we can look and see which makes the most sense? Or are there some special things about that borrower? For instance, the proprietary allows a minimum age of 55, where the FHA has a minimum age of 62.
Wow. Okay, we have 1 minute left. So how is the amount of money determined?
3 different things. Value of the home, of course, age of the youngest borrower, because it's good for both their lifetimes, and current interest rates. Interest rates sort of trump the other two. A 0.25% in interest can mean $10,000 in difference, where a year of age might only be $3,000 difference.
Okay, so Tom, if a client wants to come and talk to you about reverse mortgages, where do they go? Who do they call?
They're going to call the number on their screen. It's usually me answering the phone, maybe my voicemail when I'm out with other clients, but call the number, we'll talk. We'll kind of gather some information, figure out what's going on, what your needs are, what makes sense for you. And then usually I'll come out, we'll sit down face to face and go over it a little bit more.
Tom, thank you so much. You're
Thanks,
watching
Sarah.
2 Plus U Nevada.